Introduction to Fundamental Analysis. What is fundamental analysis? Fundamental analysis involves evaluating a security's intrinsic value by examining various economic, financial, and qualitative factors related to a company. Analysts assess financial statements, earnings, dividends, industry trends, and the overall economic environment to make investment decisions. Key components of fundamental analysis. Financial statements, analyzing income statements, balance sheets, and cash flow statements to understand a company's financial health. Earnings per share, EPS, calculating the profitability of a company by examining its earnings relative to the number of outstanding shares. Dividend yield, assessing the return on investment through dividends by comparing the dividend per share to the stock price. P/E ratio, evaluating the company's valuation by comparing its stock price to its earnings per share. Industry and economic analysis, understanding broader economic trends and industry-specific factors that could impact a company's performance. Introduction to technical analysis. What is technical analysis? Technical analysis involves studying historical price and volume data to make investment decisions. Traders use charts, patterns, and technical indicators to identify trends and potential entry and exit points in the market. Key components of technical analysis. Charts and patterns, analyzing price charts and identifying patterns such as head and shoulders, triangles, and trend lines. Indicators, using technical indicators like moving averages, relative strength index, RSI, and MACD to identify potential buy or sell signals. Support and resistance levels, identifying levels where a stock has historically struggled to move above resistance or below support. Volume analysis, examining trading volume to validate price trends and identify potential trend reversals. How to start investing. Steps to start investing. Set financial goals. Define your investment objectives, whether it's saving for retirement, buying a home, or funding education. Create a budget. Assess your financial situation, determine your risk tolerance, and create a budget for investing. Emergency fund. Establish an emergency fund to cover unexpected expenses and avoid liquidating investments during emergencies. Educate yourself. Learn the basics of investing, including different asset classes, risk management, and the impact of economic factors on markets. Diversification. Spread your investments across different asset classes, stocks, bonds, real estate, to manage risk. Choose an investment account. Select a brokerage account that suits your needs, considering fees, features, and user interface. Start small. Begin with a small amount and gradually increase your investments as you gain confidence and experience. Continuous learning. Stay informed about market trends, economic developments, and new investment opportunities. How to handle stock market failure. Strategies for dealing with market failure. Stay calm and informed. Avoid impulsive decisions. Stay informed about market conditions and the reasons behind the market downturn. Reassess your portfolio. Review your investment portfolio and make adjustments based on changes in your financial goals, risk tolerance, and market conditions. Long-term perspective. If your investments are aligned with long-term goals, resist the urge to make emotional decisions based on short-term market fluctuations. Diversification. A well-diversified portfolio can mitigate the impact of poor-performing assets. Consider rebalancing if needed. Emergency fund. Ensure you have an emergency fund in place to cover immediate financial needs without selling investments at a loss. Seek professional advice. Consult with a financial advisor to reassess your investment strategy and get personalized guidance based on your financial situation. Remember, stock market failures are inherent in investing. Successful investors learn to manage risks, stay disciplined, and adapt their strategies to changing market conditions.